Mutual funds and exchange-traded funds, ETFs, stand as cornerstone investment options, providing individuals with accessible means to participate in the financial markets. These investment vehicles offer a way for investors to pool their resources, gaining exposure to a diversified portfolio of assets managed by professionals. While both mutual funds and ETFs share the overarching goal of wealth accumulation, they possess distinct characteristics that cater to different investor preferences and financial objectives. In this exploration, we delve into the fundamental aspects of mutual funds and ETFs, examining their structures, management styles, trading mechanisms, fees, tax implications, and more. Whether you are a seasoned investor or navigating the financial landscape for the first time, understanding the nuances of mutual funds and ETFs is essential for making informed investment decisions aligned with your financial goals. Mutual funds and exchange-traded funds, ETFs, are both types of investment vehicles that allow individuals to pool their money together and invest in a diversified portfolio of stocks, bonds, or other assets. While they share some similarities, there are also key differences between the two. Welcome back to another exciting video from Blueprint to Wealth. Today's video is about understanding mutual funds and ETFs. Before we start the video, please like, subscribe, and press the bell icon. Mutual funds. Structured mutual funds are managed by investment companies. Investors buy shares directly from the fund at net asset value, NAV, which is calculated at the end of each trading day. Management style. Actively managed mutual funds are run by fund managers who make decisions about how to allocate the fund's assets based on their research and analysis. Passively managed funds aim to replicate the performance of a specific index, and therefore, they require less active management. Trading mutual funds are traded once a day after the market closes at the NAV. Minimum investment. Mutual funds may have minimum investment requirements. Fees. Mutual funds may charge sales loads, front-end or back-end fees, and management fees. Exchange-traded funds, ETFs. Structured ETFs are investment funds that are traded on stock exchanges. Just like individual stocks, investors buy and sell shares of ETFs on the secondary market through brokers. Management style. ETFs can be actively or passively managed, similar to mutual funds. Trading ETFs can be bought and sold throughout the trading day at market prices, which can fluctuate based on supply and demand. Minimum investment. ETFs typically have lower minimum investment requirements than mutual funds. Fees. ETFs usually have lower expense ratios compared to actively managed mutual funds. They may also have commission fees associated with buying and selling shares, depending on the broker. Key similarities. Both mutual funds and ETFs provide investors with diversification by investing in a variety of assets. Both offer exposure to a range of asset classes, such as stocks, bonds, and commodities. Investors in both mutual funds and ETFs can choose from various investment strategies, including growth, value, income, and sector-specific strategies. Key differences. Trading method. Mutual funds are bought and sold at NAV at the end of the trading day, while ETFs are traded on stock exchanges throughout the day at market prices. Minimum investment. Mutual funds may have higher minimum investment requirements compared to ETFs. Fees. Mutual funds may charge sales loads and higher management fees, while ETFs generally have lower expense ratios but may have associated commission fees. Tax efficiency. ETFs are often considered more tax efficient than mutual funds due to their unique structure, which allows for in-kind creation and redemption of shares. Liquidity. Mutual funds. Liquidity in mutual funds is provided at the end of the trading day when the net asset value, NAV, is calculated. Investors receive the NAV price for both purchases and redemptions. ETFs trade on stock exchanges throughout the day, and their prices can fluctuate based on supply and demand. This intraday trading feature provides investors with the ability to enter or exit positions at market prices during market hours. Investment flexibility. Mutual funds. Investors can typically only buy and sell mutual fund shares at the end of the trading day. The fund manager executes trades on behalf of investors based on the closing NAV. ETFs. The intraday trading nature of ETFs allows investors to use limit orders, stop orders, and other trading strategies. This flexibility can be particularly useful for active traders and those looking to implement specific trading strategies. Creation and redemption process. Mutual funds. Mutual funds issue and redeem shares through the fund company at the end of the trading day. The process involves buying and selling securities to accommodate investor transactions. ETFs. ETF shares are created or redeemed through an in-kind process with authorized participants, APs, typically institutional investors. This unique creation/redemption mechanism helps keep ETF prices close to their net asset value. Transparency. Mutual funds. NAV is disclosed at the end of the trading day, and fund holdings are usually disclosed quarterly. This delayed disclosure can impact the ability of investors to make informed decisions based on the most recent information. ETFs. Prices are continuously updated throughout the trading day, providing real-time information on the value of the ETF. Additionally, most ETFs disclose their holdings on a daily basis, promoting transparency for investors. Tax efficiency. Mutual funds. Due to the buying and selling of securities to meet investor redemptions, mutual funds may generate capital gains that are distributed to investors. This can lead to potential tax implications for shareholders. ETFs. The in-kind creation/redemption process can help limit capital gains distributions, making ETFs potentially more tax efficient than mutual funds. Investors may have more control over the timing of capital gains recognition. Suitability. Mutual funds. Mutual funds may be more suitable for long-term investors who prefer a hands-off approach and are comfortable with end-of-day pricing. ETFs. ETFs may be more appealing to active traders, those who value intraday trading flexibility, and investors seeking potentially lower expense ratios and tax efficiency. Accessibility. Mutual funds, typically purchased through fund companies or investment platforms, requiring a direct relationship with the fund provider. ETFs, traded on stock exchanges, making them easily accessible through brokerage accounts. Investors can buy and sell ETFs just like individual stocks. Don't forget to like this video, subscribe to our channel for more informative content, and hit the notification bell to stay updated. If you have any questions or suggestions, please leave them in the comments section below. Thank you for watching, and we'll see you in the next video.